Good afternoon all, and thank you for being with us here today. We have a fantastic afternoon plan. For those of you who don't know me, I'm Lauren Ingram. I'm the editor of Captive Review. We are really glad to be doing this session on innovation and changes, focusing on the Malta environment, but also talking about issues that are impacting everyone, like the hard market. So just before we get started, we've got a couple of things. We're going to have two panels today. Each panel will be around 25 minutes, and then there'll be some questions at the end. If you want to ask questions, please go to slido.com and put in Captive Review. That will allow you to submit a question, and then we can put it to our panelists at the end. There are some really exciting things happening at Captive Review this year. So just before we start, I want to remind you that we do have our Power 50, which is happening at the moment, which we are asking everyone to vote for. So if you go to our website, you'll get some more information about the Power 50. And we do have some last year's winners of Power 50 on the panel today, so we're very lucky. First up, we have our first panel. So I'm going to introduce our lovely panelists. We've got Ian Stafrace, Karen Jenner, and Joe Finbow, and we are going to be talking about, as I said, some interesting things that are happening at the in the market. If just wait for Karen, Joe and Ian to come on. Hello all, thank you so much for being with me today. I really appreciate it, and I know that we're all really excited to talk about this. So look, we'll just get into it because we only have 25 minutes. So, I mean, as you all know, one of the biggest issues in the industry right now is the hardening market, which is driving premiums to record highs. And recent studies have shown that. How is this having an impact on the European captive industry in general, but also in what's happening in Malta? Ian, can you start for us?
Sure. It's interesting that until as recently as 2018, with the prolonged soft market that seemed undented by catastrophes or low interest rates, people argued that the insurance cycle was dead. Since then, as we all know, trends quickly shifted, and we've been experiencing a rapid upward turn in rates, with insurers restricting capacity or pulling out from various segments. This was further accelerated by the pandemic's economic impact, and I would say in Europe by Brexit as well. The hardening market has meant that those with captives are extending their use to more business lines to improve risk financing. For others, risk managers who have long known the strategic benefits of captives, including the ability to access lower cost and higher capacity reinsurance markets, are now better able to make the risk financing case to their CFOs and boards. So far, we're seeing a higher growth in sales compared to standalone companies or captives. If I mention in 2020, Malta reported a modest 5% increase in risk carrying sales to 63. Although there hasn't been that spike in figures, these numbers are not reflective of the rapid growth the country is experiencing. As seen in various surveys, many organizations who do not have a captive are considering establishing one to help tackle the hardening market and bring the stability and control they desire, which directly rewards their risk management efforts. We are experiencing a broader scope for sales as risk managers, intermediaries, and insurtech innovators face common issues in insurance capacity and pricing. As the leading independent protected cell company in the EU with direct access to both EU and UK markets, we're well positioned to observe this. And I can share that we have received 85% more inquiries and more engagements for protected cell assessments and setups than any prior year. When considering the number of licenses, you need to keep in mind that as EU members, we are subject to more stringent prudential and conduct regulation. The setup timeframes for onshore EU insurers, captives and sales are understandably longer than offshore jurisdictions, especially where direct writing third-party risks. With the growth in inquiries and engagements, we expect to see a substantial rise in net licenses this year as more proposals move through the assessment and setup stages. Challenging the demand for captives are the increased capital requirements and costs driven by regulations, Brexit, and measures such as OECD's BEPS. However, this time, in this hard market cycle, the possibility of setting up cells is helping lower the captive feasibility entry point, opening funded self-insurance options to more organizations than ever before. Taking strength from our onshore EU-based regulatory regime, PCCs in Malta, protected cell companies in Malta, can help address many of the challenges that are coming through. Well-resourced protected cell companies can provide cells with readily available regulatory expertise, infrastructure, and economies of scale only usually found in developed insurers. For example, a PCC has one board, but it has also shared key functions, including actuarial, risk management, compliance, internal audit, that apply across the PCC's core and cells as a single legal entity. Those aware of Solvency II would also appreciate the benefit of producing a single own risk solvency assessment report, a single regulatory supervisory report, a single solvency financial condition report for the entire PCC as opposed to the individual cells. Even in terms of management time, and this is becoming even more important, this sharing of resources and processes allows the cell owners to focus more of their time on their actual risks and on their business. For smaller cells, there can also be capital savings. A cell owner will typically only need to invest own funds equivalent to the cell's notional solvency capital requirement, which with small undertakings and smaller captives often falls far below the typical standalone insurer minimums. A cell can also be a quick, simple, and less expensive means for a business to cover their immediate needs, gaining experience before possibly moving on to establishing a standalone single parent captive. I'll also mention a bit about fronting. Fronting insurers could possibly provide additional value, simplifying compliance requirements for captives and cells. They are, however, not immune to the hardening market and may therefore increasingly be selective. Fronters also add costs to the program, which may affect feasibility as well. EU direct writing cells are slightly more costly to manage than pure reinsurance cells. However, when considering the avoidance of fronting fees, they can be more cost effective. This is especially the case where local compliance and outsourcing needs in the country of risk are limited or are handled by possibly an intermediary subsidiary of the cell owner. Cells are also not just for self-insurance. Malta also enables cells to direct write third-party risks and consumer business. This is often for short tail risks. It is typical for captives and cells in Malta to be profit centers, including customer and ancillary business. And I speak for ourselves, cells targeting consumer business are a growing niche for us at Atlas, with our origins, expertise, and risk appetite as a leading local insurer in Malta. We were the first traditional insurer in the world to convert to a protected cell company, besides being the first licensed PCC in Malta. And from our experience, we know that cells based in Malta can be ideal digital insurers as well. PCCs can even be seen as a sandbox platform to experiment, incubate, launch and scale new technology-driven models at a far lower cost and capital than a standalone insurer, without that dependency on primary insurers that may be harder to find in this hard market.
Apologies, my first webinar of the year, I forget to unmute myself. Obviously, there are other considerations. So Joe, what are some of those things that people should think about?
Well, I'd like to. I think I'll leave Karen to talk a bit more about what we're seeing from the insurance premium tax side, the impact of the hard market having on insurance premium tax. But what I would like to briefly do is just pick up on some of the things that Ian was saying there from the insurance premium tax perspective related to PCCs specifically. So this increased use in PCCs and the benefits that Ian was talking about, we could definitely see in insurance premium tax compliance. So just as Ian said, you know, the PCC is a single legal entity, and this is how tax authorities view them. So to contrast, say, a traditional captive with a PCC, the traditional captive is going to have to be registered for IPT, is going to have all of the IPT compliance burden put directly on the captive. The PCC as a whole is being treated by the tax authorities as the taxpayer. And so each cell will be able to draw on the experience of the PCC manager in having to deal with the tax issues that arises across all of the cells. So there's that single resource, there's that single tax return going in, there's that single registration in the jurisdictions where the risks are being raised. So that's their place. So that's clearly an advantage there. But with that, the manager has challenges to deal with because they have the competing interests of all the different cells which they're going to have to deal with under that single registration. They're going to have to consider the fact that different cells may be doing different things. So as Ian says, you might be using a cell to selling consumer business, third-party business, which is from a premium tax perspective and many regulatory perspectives going to have very different challenges to that of a parent insured program. So that's going to be a challenge, but that challenge is for the PCC. That's for the manager to handle. So again, the cells not so much going to have to worry about that, and the manager will be able to guide them. So I think there really is truth to what Ian's saying there about the efficiencies of the PCC. But maybe I can hand over to Karen now to talk a bit about the hardening market.
Yeah, thanks, Joe. Sort of trends we are seeing aren't just coming from captives, but we're seeing inquiries from anyone who's looking at changing compliance consequences of more innovative insurance program structures that are sort of either borne out or being revisited in the hardening market. Specific to captives, I won't distinguish between single cells and PCCs, being more general. We're definitely seeing an increase in the direct writing of D&O, whether that be on excess layers, filing or filling specific coverage gaps that aren't available in the commercial market, or just increased primary layer participation because of a reduced capacity. Now, for an EU-based captive writing direct D&O coverage outside of that region, there may be challenges about writing non-admitted business, which is some of the inquiries that we're getting from captives. This leaves the captive with the additional responsibilities of ensuring that any local group entities, policyholders, are aware of their responsibilities in settling taxes that may not be part of their usual business processes, but also knowing how to fulfill them correctly, especially where they're not straightforward taxes, business taxes such as VAT or maybe GST. We're also seeing an increase in captive deductible buy-down policies being issued. A couple of things to consider there. Although the premium for that buy-down may be lower than would have been charged in the commercial marketplace, there is the additional IPT cost to consider. There's a premium against that deductible that will attract IPT. And also not just the cost has to be considered, but the additional responsibilities if that's a direct right captive in discharging those liabilities across potentially multiple risk locations. The captive premium may well not be leaving the group, but unlike VAT, it's not recoverable, so it needs to be factored into the overall picture. I think finally, we're also seeing an increased reliance on FINC, financial interest clause, quite often to support non-admitted coverages. Again, most notably on the financial line side, but more broadly, and not just from a captive perspective. But, you know, from a premium tax perspective, FINC is nice and simple. You know, gone is the need to allocate your premium across multiple risk locations. You know, the premium is allocated entirely to the parent's domicile, the risk insured being the balance sheet risk of the parent. And that means one IPT regime, one tax calculation and one declaration. You know, nice and straightforward from our perspective, from a compliance perspective. But as we know, there are, you know, some serious considerations of using financial interest clauses, particularly for a captive, you know, with the claims paid to the parent. Any local suffered loss isn't technically insured, and any subsequent cash injection from the parent to the local entity could attract a different kind of sort of corporation tax. And I think one final comment to make around the hardening market is that, you know, higher insurance premiums attract higher levels of IPT, which you know, means compliance is just as important, if not more important than ever. I mean, and Joe, I think, has a couple of examples. We're now actually starting to see European tax authorities increase IPT rates, nothing to do with the hardening market, but possibly more to do with the ongoing pandemic.
Yeah, indeed. I mean, we've seen already from the 1st of January this year, Spain increased its IPT rates. The first time it's done it in 23 years. You know, it was a bit of a shock when it finally happened. The German tax authorities have made some significant changes to their tax regime, really looking at increasing their tax take on IPT, really focusing on IPT there to do that. And France has been implementing changes to help fund the health system, which has been sort of perceived to be underfunded because of COVID, and so there's been new taxes introduced to deal with that. We've got the UK budget coming up soon, and there's a lot of discussion around whether IPT is going to increase in the UK again. So it's an easy one for governments to go after, if you like, insurance premium taxes, and I'm really expecting to see many more changes and increases coming in the near future. Yeah.
I mean, I think, as you say, this is something I'm also hearing all over in terms of it's an easy way for governments to hit that doesn't hit kind of voters directly. You know, you're not raising people's take-home pay, and so it's a little bit easier for people to take. Also, really interesting what you were saying, Ian, in terms of, you know, the increase in inquiries you've had, because we're doing our world domicile update at the moment, and for the first time we're asking people to report to us both the amount of individual cells and cell structures and basically the type of captives that have been formed. And what's really interesting there is that we are seeing cell captives even last year just increasing so much quicker in percentage than pure captives or group captives, which is, I think, something that's going to continue. And so I guess one of the other big impacts this year, especially considering European captives and UK captives, is Brexit, obviously, on the impact of that on the European captive industry. There was a lot of talk prior to Brexit about what would happen once 2021 left and the UK left the European Union, but there was a lot of things that people didn't know. So what do we know now about what it means for captives? Does anyone want to take that first?
I'm happy to start. I believe I think I mentioned it briefly earlier, but I believe the barriers raised by Brexit have contributed as well further to the hardening market. This did trigger further withdrawal of insurers from markets no longer considered feasible because of Brexit. And continuing on the point that you mentioned, Lauren, unlike the cells that grew in numbers, in 2020 we had a slight net reduction in standalone non-domestic insurers and reinsurers. We had 5 surrender their license and 3 were added, bringing the number to 60 standalone companies. At least 3 of the 5 surrenders were directly writing risks principally in the UK, and therefore the surrenders were likely driven by Brexit. The situation is different on sales for all the reasons we mentioned earlier, but also more than that. Following Brexit, Malta is now the only EU member state with protected cell legislation, with Gibraltar and UK no longer being in the single market. We are therefore the only country to offer such a lower capital and lower cost of means of maintaining access to the single market, as we have mentioned. Further to that, thanks to the cost burden sharing that PCCs can offer, PCCs such as Atlas pursuing a UK branch license are uniquely providing access to sales to both EU and UK markets from the same entity, further contributing to the sale growth. Besides these risk-carrying sales, I should mention in the context of Malta, Brexit also has rapidly increased the number of broker sales, it's a very unique offering in Malta and another route for UK intermediaries seeking to maintain access to the EU market. I should also mention the need for substance, which rose further with Brexit. Maybe not many might have noted this was one of the causes. This need for substance had already increased once OECD had presented its BEPS action plan. Despite intending to address tax avoidance in practice, BEPS can be overly burdening on genuine captives due to misperceptions on their business models. The need for increased substance was further driven in the EU by Brexit. It triggered EIOPA to lay fresh pressure on national supervisory authorities to require insurers to have sufficiently adequate on-the-ground staff and key function holders within the EU. And it has been challenging for regulators to apply proportionality in this regard, especially when third-party risks are also being included. Protected sale companies can significantly help address such substance requirements. As we've mentioned, sales form part of a broader single legal entity, and taking ourselves as an active leading domestic insurer, Atlas naturally provides ample substance when you consider our over 190 staff, multiple premises, substantial capital surplus, and all the functions and resources necessary already based in Malta. So when we talk about protected sale companies, the front-end sales policy administration and claims handling, where applicable, can still be outsourced to intermediaries and third-party administrators. But the PCC then provides the board, the core functions, governance, and so on in Malta, mitigating these additional substance requirements and needs triggered by Brexit or other pressures.
Karen or Joe, would you like to add to that?
Yeah, I mean, taking the regulatory piece aside, we're not qualified to talk about the regulatory position of insurers in the UK, but if we look at the Malta market writing business into the UK following Brexit, I mean, at TMF for years, we've supported many non-EU insurers register for and file taxes with HMRC in the UK. I mean, HMRC have historically actively sought the filing of and settlement of IPT on all insurance, regardless of where in the world the policy was issued. And I mean, where European entities set up a UK branch in the UK to handle UK risk, that branch itself would then register to file their taxes. So for Malta insurance companies writing into the UK, we're not foreseeing compliance issues. But Joe, I think you might have a couple of pertinent points worth considering here.
Yeah, I mean, like you say, the UK is set up to be collecting taxes from around the world. So actually, HMRC's view of Brexit from an IPT perspective is that, well, it doesn't really change anything at all. The regulatory piece aside, if you're writing the business and tax is due, you've got to pay it wherever you are in the world, and we'll accept your direct registration wherever you are in the world. So that's that. And the issue is possibly bigger for UK insurers writing into Europe. Any that are still considered able to do it will be coming across issues of having to either appoint fiscal representatives because UK entities are now domiciled in a third country, so they need a fiscal representation in Europe, or the responsibility for the tax compliance is shifting away from the insurer to the policyholder. But the one change that we have actually seen go into law in the UK as a result of Brexit in relation to IPT is the tax office's ability to pursue policyholders where they have purchased insurance or paid premiums to an EU insurer that has failed to pay the tax. So previously, this was a provision which only applied to non-EU insurers. So a UK policyholder buys insurance from, I don't know, a Bermuda insurer or Bermuda captive, and that insurance entity hasn't paid the IPT. HMRC could pursue the UK policyholder, but they couldn't if they bought that premium from an EU domiciled insurer. The reason being, HMRC, the UK tax office, had the Mutual Assistance Directive, which allowed them to go directly to the tax authorities or the regulator in Belgium, France, Germany, across the EU, and directly ask for their assistance in the recovery of taxes from entities in those jurisdictions. But that's obviously gone, so we've had to update the law to say, look, we'll go after policyholders in these cases as well. It's not often used, but it's that power is there now. But what we're seeing now is that HMRC, possibly not directly as a result of Brexit, but they are looking to improve or update their processes and to modernise the insurance premium tax in the UK. And there's sort of two key areas that are maybe relevant here. The first is they're exploring the idea of asking captives to disclose their parent company. When registering for UK IPT, the captive would have to say who owns them, declare all their interests there. Now, that's not going through yet, but it's an idea that has been proposed by the UK tax office. And another one is to try and tackle this idea of unregistered insurers. So this would apply to captives or to any other insurer that is not registered. And HMRC sees this as a problem area where there's IPT leakage because you pay a premium to an unregistered insurer and they don't pay it on, or they don't even collect it from the policyholder in the first place. And they're looking at ideas such as a register of registered insurers, which would be, I think, very useful for buyers of insurance, because they could see, is my insurer registered for UK IPT? Is my insurer a compliant insurer? So I think that's an interesting idea. But they're also exploring other ideas such as brokers declaring when they've come across an insurer who is not registered. And finally, also maybe more of the stick approach rather than the carrot approach, they are considering making brokers joint and severally liable for the IPT if the insurer that they're placing it with doesn't pay. I'm not sure how well that's going to be received by the broker community, but it's an idea that's been put out there anyway.
So we've got some questions. So I thought we might move on to the questions, but quickly before, is there anyone who has a quick thought that we haven't covered? Okay, good. So we've got a couple of questions here, so I'll just go on to that. The first one is for you, Ian. It says, have you experienced any potential interest from captive owners looking for legacy solutions for better optimization of capital? Sorry.
I know there are actually specialized outfits from Malta which are doing exactly that. So running on providing legacy solutions in Malta, both as a protected cell company where the cell owner might have either some participation, or they may allow for third parties to invest in that cell. So it allows the legacy provider to mix and match who is investing in that protected cell legacy, whether it is the originator keeping a piece of it, or whether it is involving third-party investors into that model. So yes, we've seen interest in that area in Malta.
We've got another one here for Karen saying, picking up on Karen's comments about D&O cover. And are you seeing captives writing side A or B and C cover, or all of them?
The inquiries we've had have been more generically around D&O cover. We haven't seen any specific inquiries on side A to date.
Yeah, because
that doesn't mean to say they're not out there.
Well, I do think that there is, from what I'm hearing, there is more kind of interest in that now, because obviously traditionally that was never done. So if I get to see a case study, I'll be very happy, because I'll be very interested.
What I can add on, just not on D&O, but on professional indemnity, the premiums have been just skyrocketing in the past months. I mean, we've seen some cases where the premium went 4 times, 5 times as much. So it's the interest in that area has definitely increased particularly.
We don't have any more questions for this panel, so I just want to thank you all for coming on, and it was very, very interesting, and I'm sure everyone got a lot out of that, so thank you very much. And now we are going to introduce our next panel, so there'll probably just be a moment while that switches over. Here we go. So here we have Elizabeth, who is the moderator for our next panel. So I'm just going to hand over to her, and she is more capable than I am of taking it from here.
Hi, thank you, Lauren. Much appreciated. Good afternoon, everyone, and welcome to the second session on innovation, regulation, and the future of captives in Malta. A brief introduction to the panel. So, as Lauren mentioned, I'm Elizabeth Carbonaro. I'm the chairperson of the Malta Insurance Management Association. Joining me is Mr. H. Kembry, who's the head of the Insurance and Pension Supervision within the Malta Financial Services Authority, or the MFSA. Dr. Matthew Bianchi, who is the vice chairman and one of the governors of Finance Malta, and Mr. Colm McAuliffe, who is one of the directors and the chief investment officer within Kurmi and Partners. So thank you all for joining in this panel. I think I'll start the first question. Really is for Ray. I'm going to touch on a little bit what was mentioned in the previous session in terms of the hardening market and the attraction or the what captive advisors are seeing at the moment vis-a-vis increase in interest in captives. And so from this point of view, where we're seeing ourselves being increasingly involved in feasibility studies for clients. So from a regulatory side, are you seeing this filter down through applications for formations of captives in Malta? So what are you seeing at your end in terms, from the regulatory side of things?
Well, Liz, if I had to take you a bit back to what happened last year, obviously it was like everyone else's, it was a very challenging year for the supervisor. We did get the usual, apart from the obviously COVID challenges, we also got a number of applications for Brexit purposes and the usual steady flow of direct writers. But towards the end of the year, we actually got our silver lining, I suppose, and there we saw a renewed interest in captives, which I have to admit we haven't seen for quite some time. In terms, as you're saying, I mean, we did have a number of initial queries, but we also got full applications. In fact, one of them is just about to be licensed right now. And that in itself also is very satisfying from a regulator perspective, because clearly captives do fit very much our risk appetite, from obviously from our point of view, from a regulatory risk point of view, and then let's say for this year we are looking at pretty promising numbers as well.
Okay, I think in terms, maybe adding on a little bit to this, are there any specific risks that you're seeing being placed into the captives, and vis-a-vis your own general approach when considering applications for licenses for captives in Malta, how are you applying proportionality to captives, specifically, you know, within the Solvency II environment?
Well, I mean, we did have kind of quite a varied range of captive inquiries, but clearly, as pointed out in the panel before this one, there is clearly a huge interest in the financial lines area, D&O, PI, etc., where we understand premiums have increased significantly possibly due to capacity reduction in the market. But also we've seen some interest, quite some interest in property damage as well, and other areas. We've also kind of seen a bit of a renewed interest in kind of risks which are not normally insurable or readily insured in the traditional market as well. So quite a varied mix, but clearly financial lines is the top item there. When it comes to our reaction to captives, as I was saying before, this very much fits our risk appetite. Clearly, our approach is always risk-based, applying all the proportionality principles. So it comes to captives, we tend to very much streamline as much as we can, clearly depending on the risk itself, but in a number of areas, when it comes to regulatory expectations, when it comes to governance, substance, and reporting. So clearly, we do adapt to kind of the different risk being presented by captives, the limited exposure to what we internally call kind of third-party risks. So this is all internal risks, so we do treat them quite separately from the normal direct writing applications that we do have. I think you're on mute, Liz.
Okay, I just unmuted myself. Sorry about that. Matt, I saw you trying to add on something. Yeah, Matt, you're on mute. Matt, you're on mute.
Okay, is it fine now?
Yeah, that's better. Yeah.
All right, sorry about that. No, I said it's good to have the regulator on the line and be able to ask a question or make a comment. All I wanted to add, Ray, is from our perspective in the market, and I'm here talking for Finance Malta, but I'm also a practitioner here. Evidently we've seen, more emphasis in terms of speed when it comes to license turnaround, and I suppose that's one of the things you've been working on as a regulator, particularly for the captive market. And I thought I'd point it out and see if you wish to add in.
I mean, yeah, clearly, again, speed, when you have a captive application, there are certain complexities of direct writers do tend to go away. So clearly we can be having a much faster turnaround of those applications.
Matt, and also maybe attaching on to also what was mentioned in the previous session, certainly what Ian made reference to in terms of the interest for sales. Looking from your end, whereas as a general practitioner, you tend to get probably a wider overview of what is happening in Malta. Are you seeing the sales being more dominant? Are you seeing direct writing captive companies? I mean, what are you seeing at your level here?
Clearly, as you said, we tend to see obviously not as broad as the regulator, but we tend to see quite a broad spectrum of what's happening. And you're right. I think the sale market, and Ian said this before, and Joe too. The sale market is clearly the bigger chunk of what's happening. And I think there are two sides to this. A lot of this is Brexit and the effects pre and post Brexit. But the hardening market is another. But I think the big one that stands out, and maybe we haven't quite mentioned yet, is the fact that Malta is now probably, and I say it quite confidently, I think we are the only jurisdiction in the EU with protected sale legislation available, definitely to the broker sector and the manager sector, but also to the insurance and captive sector. So I think that is one of the big reasons why, by definition, if there's interest in sales and having captives or carriers in sales, then Malta has to sort of pop up, because we're not there competing with many jurisdictions. Plus, I mean, the fact that we've now been through, what was it, Ray, 2006 when we introduced sale legislation. So we've actually built up quite a repertoire there, which means that there's a cluster of PCCs now that exists in this. And it's active. It's active. PCCs are vying for business, and as you know, Liz, there's a strong runoff and legacy line here. So a few big groups and operators, running that line there, so that there's that micro cluster. But I think the broader cluster of PCCs is able to provide the market with services across the plane. So you have your independents, as Ian pointed out earlier. But then you also have your big insurance groups, the Willises, the Marshes, the Aons, etc., all running their own captive PCCs out of Malta too, and that is a huge advantage. So when you sort of look at the whole array we have on offer, I think it's quite a spread, and it the success we're having in that area. Naturally, you can't forget about the standalones and the captives or carriers, which would be your typical standalones. And as Ray pointed out, there's that happening too. But my sense is there's more happening in the PCC space. And what's interesting is that we're also seeing movement in the intermediary / PCC phase, which fine isn't captive, but it's sometimes it's just an insurance sort of plugging in a group. So there's a likeness there. There's a similarity to what's happening in the captive world, and it sort of adds to this complexity in the market of the offering.
And then if I may, I just adding to points made by Matthew. It's not only that the PCC structure, the PCC legislation is quite well embedded now, but we're also looking at fine-tuning certain aspects of the PCC legislation to look at sort of niches like the running off of cells, the transferability of cells to make sure to kind of continue building. I mean, this is nothing revolutionary, clearly just an evolution of the cell structures to fine tune them to fit into our future.
Yeah, because to date, what we've been doing is we've been borrowing from the non-PCC world. So if you're dealing with assignment of cells, then you're doing it happens, so it's available. But what we're saying is you're going to probably package it into a more streamlined manner, which is great news, actually. Well done.
And in terms of maybe structures or types of risks that are being placed in captives, Matt, are you seeing anything which is maybe different, or are you being approached to assess certain types of risks which traditionally might not be included in captives?
I think D&O and PI are on the tips of all our tongues, so it'd be silly to ignore them. That a lot of that is happening, but I wouldn't say it's exclusive to D&O and PI. There's a lot of other areas. Malta has traditionally been a great jurisdiction for warranty business, for instance, and there's I know a lot of that happening. Property damage too. Ray singled that out earlier, but once this is a session about innovation, probably the innovation is really around that D&O space, and hopefully if we do manage to put together a model that will work, we could, again, with the help of the operators and the regulator, you know, come out with a model that would be, you know, another one of the, you know, another bit of armor in our chest, in our offering. And I have a feeling that there may be breakthroughs around captives and D&Os for Malta. On mute.
And I am unmuted. Yes, from an operator's point of view, you know, we're also seeing an interest in that. So what has traditionally never really been considered for a captive is now being looked at as a possibility.
Mm-hmm.
I think maybe now I'll turn a bit to Carl. Carl, so one of the things that we've been discussing in this session and the previous session is the hardening market and therefore the impacts on the hardening markets. If we had to look at it with an investment hat on, is in your view, has the current investment climate also contributed towards the hardening market? You're on mute, Carl. You're on mute.
Okay. The markets in general, probably over the past almost 1 decade, has, in our opinion, postponed the hardening from happening. What we are seeing now is, in our opinion, also a result of the reality of the capital markets. If we were to look back 7-8 years ago, what the investment parameters of an insurance company looked like, and what the returns that could have been generated with those investment parameters were, and you compare those parameters to today to generate the same returns, capacity is going to be taken away. If we look at the balance sheet of a company and we say, okay, where is this capacity going to be used by the company? Is it going to be used in its core operations, or is it going to be used in the investment portfolio? Today, a lot more of that capital would need to be used to generate the minimal possible real return, because post 2011 there was just a race of seeing interest rates getting lower and lower and lower. For half a decade, insurance companies were generating equity-like returns with extremely conservative investment parameters, and now that story is over. The easy money is being done, and to generate the same sort of return, companies need to expose capital to riskier assets, which bring with them higher capital charges. So we're looking at the lower end of investment-grade corporate bonds, sub-investment-grade corporate bonds, and even equity and private equity. And these all come with higher capital charges, which to a certain extent reduce capacity. So if the market was looking at sort of repricing at the beginning of the previous decade, then what we saw happening in the capital markets only helped postpone. What we're seeing today is not entirely surprising either, however.
Ray, Matt, do you have anything maybe to add on, or any other links to?
There's a call coming in. Well, I mean, I don't know whether it's a blessing or not. You know, the current climate is, you know, yeah. I don't know. I mean, honestly, it's not my area of expertise, but you can tell it's impacting the market tremendously. So,
okay.
So you know, on the one hand, rates being lower are a good thing. On the other hand, you know, you have this impact on the insurance market we're now suffering.
Okay. Remaining on the topic of investments and investment climates, Carl, vis-a-vis ESG, are you maybe looking at ESG being discussed more now at the level of captives, or do you still think that it's maybe not one of the main items on the investment committee of a captive?
No, I think it is becoming an item on the agenda that is being given more and more time and more consideration. And in our opinion, there are three reasons for that. First of all, ESG has a very long history. There was corporate social responsibility, then there was social responsible investing. Now we have ESG, and there is data now that one can analyze and see that to a certain extent introducing ESG metrics. So for example, ourselves as investment managers, introducing a non-quantitative metric in our analysis, a qualitative metric, could actually provide better returns. Now that is sort of generic, and it's a very positive thing to see. Specifically for the insurance industry, we believe that these ESG metrics are being considered more and more, specifically relating to the point we were talking about earlier in terms of capacity, because investments that have high scores from an ESG perspective could actually benefit from a reduced capital charge in terms of Solvency II. So when an insurance company is looking at its investment portfolio in terms of expected returns, and it is looking at it specifically in terms of expected returns on solvency capital, not just on capital employed, introducing ESG metrics makes a lot of sense, because it could actually mean that you could have a portfolio that purely from a return perspective gives you a better profile when compared to the solvency capital charges. Not to mention then the risk return profile, because introducing ESG metrics can also potentially improve your risk reward profile of the portfolio, especially for a captive company, because a captive company can really be hit if ESG metrics weren't part of the investment parameters. A captive company, depending on the type of business that the parent or that it is writing, can really be hit on both sides by just one event. It can be hit on both the investment portfolio because of the underlying exposure it has to various industries, and so that's on the asset side. On the liability side, because of the actual business that it is writing and the claims that are coming in. Having let's say these discussions are very important, especially from the risk perspective. Now, to what extent, to what degree these ESG metrics are designed, developed, and implemented is, there's a lot of discussion going on around that. But at least, there is it's not only at its early stages. These discussions are actually today resulting in such metrics being implemented, because there are the tools, there is the data that would allow an investment manager to assist an insurance company in implementing those metrics in its investment portfolio.
Thanks, Carl. That's very interesting. I mean, I can say from my own experience in that we do have certain captives where they are actually looking at ESG, and a lot of it is also driven from the group. So the group itself is introducing ESG, and automatically it starts, trickling down, even to the captive. So it's interesting seeing that.
Possibly it's also being driven. Possibly it's also being driven from the top end, because the parent company itself is aiming to have a very high ESG score, to be able to raise capital in the capital markets at favorable rates. So there is this very interesting dynamic from a pure capital perspective, in that, first of all, probably today capital is very cheap to raise. But it can be even cheaper if you're scoring very strong ESG metrics. So that has to be translated down even into your investment portfolio.
Is it? Can I ask a question? Is it a broad market though, Carl? Is it deep? I mean, are there a number of options, or are we limited there?
It is. I mean, ESG in its broadest definition really covers almost all the industries. Where the restrictions come in is whether all the participants in the various industries, i.e. the specific companies, are providing the data to third parties to be scored and to be given an ESG score. I mean, you can even have companies that are in the energy industry, and by energy, I'm actually referring to oil exploration and production. That could be having quite a decent ESG score because it's also a reflection of what the company is trying to do. What footprint is it leaving behind once it is producing whatever it is doing? So the market is wide, and it is getting wider. It is more what's interesting about it is that companies are recognizing the need to have a score and the need to score highly because portfolios are starting to adopt these ESG metrics, and therefore it could be that at the end of the day, it's their shareholders that are going to suffer, either through more expensive capital because they would have to pay, let's say, higher coupons on their bonds, or have more restrictions on their bonds, or actually have equity which is still pretty expensive vis-a-vis their peers that are scoring very strongly on an ESG front.
Okay, I think I'm going to have to. It's an interesting discussion. I think we can't go on for ages, but we've got a couple of questions from the audience, and some of which I think I'm interested myself as an operator to see the response to these questions. Ray, unfortunately, they are questions specific as the regulator. I think you figured that out.
We're used to making the questions ourselves usually, but yeah, fair enough.
I promise is not my question. I promise it's not my question. So an audio question. Guernsey has recently launched a fast-track pre-authorization for insurance sales. Would the MFSA deem such a scheme as appropriate for Malta, specifically for captives?
Okay. In a way, yeah, I've come across this particular development from Guernsey. As Matthew was referring to earlier, we do fast track captives clearly. I mean, because of our risk-based approach. So at this stage, quite frankly, from the demand we've had, I don't see any particular requirement to provide pre-approvals. And then in the case pre-approvals do raise quite some questions, to be honest. But I mean, from what we've seen, we've never come across any instance where there was that need for a kind of instant turnaround. That maybe this is what we are referring to. We can be quite flexible. So even if a company wants to explore a captive solution and they will want to come with a sort of an in-principle approach, yes, we are prepared to consider in kind of so far as we can go. Probably not put up an entire license, but have something ready for when kind of the need arises.
Okay. I think the Guernsey one, from at least from what I've read and from what I've seen, I think it's a very fast track. I think it's in the region of a couple of weeks for a fast track. So,
well, to be honest, if for and again, I always underline high quality application.
Yeah.
Quite frankly, we're not very far from that.
Okay, very good. That's good to know. Another question which has come from the audience, and I think again, Ray, probably it's a question for you. how many new insurers, CILs or standalone, have been licensed by the MFSA so far in 2021? And how does that compare with 2020?
Oh, okay. So far in 2021, well, we've just started 2021. What I can say is that we do, I don't have the numbers, quite frankly, here with me. But last year, let's talk about last year. We've seen an increase not only in quantity, not only in the numbers, but also we've had some high-profile names coming over as well. This year, all I can tell you is that it's very promising. Let's put it this way. Sorry,
Okay.
but
Don't tell us how many
to get out of out of that.
Okay. Does anyone? I think we're probably more or less running out of time as well. Are there any other observations? Any other comments that the panel wish to?
Maybe Ray, what you didn't say when you spoke about pre-vetting or pre-agreeing is you do actually sit down. We do actually sit down, because we've done it together quite often, with applicants at an early stage and establish a timeline, Liz. No, and that's
Yes. We've done that, and it works. I'm saying my own personal experience.
Yeah,
now.
I think yeah. But both of you can.
I can vouch to that.
Can vouch for this. When we are faced, particularly with corporates want a quick turnaround, we're prepared to sit down, go through what effectively is a project management plan, and establish timelines. So as long as you produce this date, okay, so we'll, if we agree on application on 1st of March, I'll make sure that the team is quite clear on the first week of March to be able to kind of respond to that. And that does tend to shorten times. I mean, as long as there's clear commitment from the promoter to go along with that timeline. But I think the sort of, as I say, sort of project management approach that everybody knows when his turn is to do whatever the task is, I think does help to, because even from internal planning, I mean, it's not just a question of, one person seeing the application. No, there's a whole team. There are all sorts of buy-ins that one has to get from all aspects of from both our team as insurance pension supervision, as well as conduct, FCC, digital. Nowadays, obviously, we've gone a bit more complex structure, and that's a good plan does help a lot here in making a much faster turnaround.
Yeah, that's nice.
In terms of Ray, again, in terms of any regulatory changes or anything which is in the pipeline which could have a direct impact on captives and their setup, or is there anything in the pipeline?
Apart from what we were saying previously on the cell structures, where we are fine-tuning the model, just making it hopefully better but definitely clearer. On the captive side, we're now waiting the conclusion of the Solvency II review by EIOPA, where captives, there is clearly an acknowledgement of proportionality when it comes to captives, and I guess that would be the major development we're looking at, particularly at this point in time.
Okay. I think at our end, we've probably exhausted, well, I've exhausted the questions I had to ask. I don't know if anyone else has any other questions or any other observations that you wish to raise or ask.
Have we gone through all the questions you received?
We have, and we've also gone through the questions from the public. I don't have any others that have come in. I'm just going through. No, I don't have any others. And I'm seeing Lauren coming on. Yep. Hi, Lauren.
Hi, that was wonderful. Thank you all so much. We did get another couple of questions, but they were basically the same as what the other ones were asking, basically asking Ray, like, how many captives are being formed this year, and, you know, all of that. So I didn't want to put the pressure on him.
And enough to keep us busy, Laura.
Yeah. But thank you all so much. This has been such a wonderful afternoon, and I really appreciate all your expertise. I have learned a lot. So I just want to thank everyone watching. That's the end of our session. Just to remind everyone that we do have our UK Captive Summit, which is on next week over 2 days. That's going to be really great. So if you haven't signed up for that, go to our website. And as I mentioned in the first panel, we have our World Domicile Update issue coming out next month, where we do track how all of the domiciles have done, and just kind of track what captives are doing, basically, and where they're being formed over the world. So make sure you come on for that and look out for that in mid-March. And thank you all, and have a great afternoon.
Thank you.
Thank you.
Thank you.
Bye.
Bye-bye.